You have probably heard it your entire life. Renting is throwing money away. Buying is the smart move. Build equity, invest in yourself, but nobody runs the actual numbers in front of you. So that is what this video does. No opinion, just the math, and what it actually means for your decision in 2026. The 2026 numbers. In the United States, the median monthly mortgage payment in January 2026 was $2,070, according to the Mortgage Bankers Association. That is principal and interest only. It does not include property taxes, home insurance, or maintenance. The national median rent in January 2026 was $1,353, down 6.2% from its peak, the sixth consecutive monthly decline, according to national housing data. So on a pure monthly basis, renting is currently cheaper by roughly $700 a month before you add a single dollar of ownership costs. Now add those costs. In 2026, the average annual home maintenance bill in the U.S. is $10,867, according to definitive Calc. That is over $900 a month. Property taxes and insurance add another $400 to $600 depending on your market. The real monthly cost of owning that median home is closer to $3,400 to $3,600. Against a $1,353 median rent, that is a gap of more than $2,000 a month. For the first several years, renting is almost always cheaper on a cash flow basis. The myth that won't die. Renting is not throwing money away. You are paying for housing, a place to live, without any of the financial exposure that comes with ownership. What you are not doing is building equity, but equity is not free. In 2026, with a 30-year fixed rate at approximately 6.1% according to Freddie Mac, the majority of your early mortgage payments go to interest, not principal. On a $400,000 loan, over the first 5 years, you pay roughly $116,000 in interest and build only about $35,000 in equity. That $116,000 does not go to yourself. It goes to the bank. It is not equity. It is interest. It is the cost of borrowing money. Buying has equity building built in, but it is slow at the start and expensive to enter. The down payment. Nobody talks about. The median U.S. home is $412,000. A 10% down payment plus closing costs means you need $50,000 to $61,000 in cash before your first mortgage payment clears. In Canada, the national average home price is $670,064, and at median income with a 4% savings rate, CPA Canada calculates it takes nearly 15 years to save the minimum down payment. The debate about monthly costs is real, but for most people, it never gets that far. The barrier is the cash required on day one, when buying wins. Here is the honest case for buying. According to Adam's 2026 Rental Affordability Report, it is already cheaper to buy than rent in 57.7% of U.S. counties when you assume a 20% down payment and compare against renting a 3-bedroom unit. Wages are growing faster than home prices in 2026, with Redfin forecasting home price growth of only 1% this year. Mortgage rates at 6.1% are their lowest since September 2022, per Freddie Mac, and the median mortgage application payment fell from $2,205 in January 2025 to $2,025 by December 2025. Most importantly, your mortgage payment is fixed. Your rent is not. A 30-year fixed rate means your principal and interest payment in year 30 is identical to year 1. The national median rent has historically grown 3 to 5% a year. By year 10, the renter paying $1,353 today could be paying $1,900. The buyer's P&I payment has not moved. The break-even point, where buying becomes cheaper than renting on a total cost basis, typically lands between 4 and 6 years in most markets today, accounting for closing costs and the opportunity cost of your down payment. The framework. 2 questions determine your answer. First, how long are you staying? If under 4 years, renting almost certainly wins. Transaction costs alone eat your equity. If over 5 years in most markets, buying begins to pull ahead. Second, what is the price-to-rent ratio in your city? Take the home price, divide by annual rent. Below 15 favors buying strongly. Above 25, which covers much of Toronto, Vancouver, San Francisco, and New York, renting is often the smarter financial choice. Not because of feelings, because of math. The real cost of buying in 2026 is higher upfront, higher monthly in the early years, and requires significant cash reserves most people do not have. The real cost of renting is lower immediate cash outlay, zero equity, and exposure to rent increases you cannot control. Neither choice is universally correct. The median U.S. mortgage payment, $2,070. The median U.S. rent, $1,353. The average annual maintenance bill, $10,867. The break-even timeline, 4 to 6 years. The down payment required in Canada to hit median price, 15 years of saving at median income. Run those numbers against your city, your timeline, and your cash position. That is your answer, not a bumper sticker, not what your parents told you, the actual math.